As an investor, how do you navigate the vast sea of investment opportunities to find a strategy that promises growth, good returns, and proper risk management? In the world of investing, staples like the S&P 500 and the NASDAQ 100, tracked by ETFs like SPY and QQQ, are common in portfolios. These indexes provide broad market exposure, reflecting top U.S. companies. The S&P 500 offers diverse representation across sectors, while the QQQ leans heavily towards tech, offering a slice of the most dynamic but sometimes volatile sector. However, these traditional options come with their limitations. The S&P 500, while diverse, can be sluggish, its broad exposure diluting the impact of high-growth sectors. While often rewarding, the QQQ tech-heavy lineup carries the risk of volatility, making it susceptible to sector-specific downturns. This is where growth at a reasonable price steps in, a strategy that seeks to harmonize the growth potential of stocks with their current valuation, ensuring investors are not paying a premium for future growth that may or may not materialize. So, how exactly does GARP work? And is there an ETF that meets the GARP requirements? Well, as we dive into specifics of GARP and the ETF that mirrors its philosophy, we'll explore how this strategy stands as a superior investment approach. Without further ado, let's get into it. Understanding GARP. Ever heard of the term GARP? Growth at a reasonable price, or GARP, emerges as a harmonious blend of two distinct philosophies: growth investing and value investing. This strategy offers investors a path to navigate the complex landscape of the stock market with a balanced approach. GARP investing is not just about chasing the next big thing or hunting for undervalued gems in obscurity. It's a disciplined pursuit of companies on a growth trajectory, but not priced at a premium. This strategy thrives on the principle that investing in companies with solid growth prospects and reasonable valuation can lead to sustainable, long-term gains. It's about finding that sweet spot where the potential for growth meets the security of value, a nexus where the risk of overpaying for hype is as diligently avoided as the trap of investing in stagnation. The significance of GARP lies in its dual focus. On one hand, it seeks out companies with robust earnings growth, a hallmark of growth investing. These are the companies shaping the future, driving innovation, and capturing market share. On the other hand, GARP emphasizes buying these growth stocks and prices that make sense, borrowing a page from the value investing playbook. This means looking at metrics like the price-to-earnings ratio and ensuring that they are in line with the company's growth prospects rather than speculative bubbles. GARP investors enjoy the growth of their investments with peace of mind that they have not overpaid for their returns. So, GARP isn't just a fancy term, it's a pivotal investment strategy worth remembering. Finding a single investment that ticks all the boxes is challenging, but it's certainly not impossible. So let's save you that time and give you a hidden investment gem: the SPGP ETF. Investing in growth essentially means backing companies with strong earnings growth. But there's a catch. Any investment tied to exponential growth is also susceptible to significant downside risk, making growth a double-edged sword. Take the NASDAQ 100 index, for instance. This ETF has delivered an impressive 16% annual return over the past 15 years, outperforming a large portion of hedge funds. However, timing is crucial. During the bear market of 2022, the QQ lost over 33% of its value, highlighting the inherent volatility. While it did see a 40% appreciation, had you invested at the start of 2022, you still wouldn't have broken even. Even without factoring in dollar cost averaging, a $1,000 investment in 2022 would have dropped to $660 by the year's end, only to bounce back by 40%, bringing your total to $936. Yet you'd still be down roughly 8%. So while the QQ is indeed a growth machine, you're also far more likely to get into deep losses. This is why many investors tend to shield themselves with value investing, picking only those stocks or ETFs that have not taken off. But here's the twist. While it shields you in a bear market, value investing often means missing out on potential gains. It's a trade-off where dampened downside volatility comes at the cost of limited upside potential. What we're after is the best of both worlds, combining growth investing potential for significant appreciation with value investing protection against downturns. This is where the SPGP ETF, or the Invesco S&P 500 GARP ETF, shines. It represents a commitment to the GARP philosophy, selecting stocks from the S&P 500 that offer the best of both worlds, the dynamism of growth and the stability of value. This isn't about chasing shadows or getting lost in the market's noise. It's about finding clarity in the chaos, identifying companies poised for growth but not yet priced beyond their true worth. So, how has this ETF performed in the past? Historically, the SPGP ETF has charted a course that many have found to be both enlightening and profitable. The fund prides itself on selecting stocks through a GARP lens and has shown a remarkable trajectory since its focus shift in June 2019. Starting with its performance, let's look at how it's fared. In 2019, after adjusting its sales towards GARP, the ETF began to showcase its potential. By the end of the year, it had navigated through the market with grace, even as the waves of volatility crashed around. Fast forward through the years, and the SPGP ETF has held its ground and thrived. It carved out gains each year, even in the most tumultuous times. For instance, during the roller coaster of 2020, when markets dipped and dived, SPGP showed resilience and recovery, mirroring the broader market's rebound, but with a grace that spoke to its strategic positioning. The method to the magic involves a keen eye for companies excelling in earnings and sales growth, but that's just the start. The real art is in balancing these growth prospects with metrics that speak to a company's quality and value. So let's dive into the concepts behind its selection criteria and how they contribute to its standout performance. Key factors driving SPGP's success. When it comes to the proper way of investing, the SPGP ETF distinguishes itself through a meticulously crafted strategy focusing on several pivotal factors. These include earnings per share growth, sales per share growth, and a composite score assessing quality and value, alongside the significance of financial ratios such as leverage, returns on equity, and price-to-earnings ratio. At the heart of SPGP's strategy is the pursuit of companies with robust earnings per share growth. This measure reflects a company's profitability on a per-share basis, offering a clear window into its financial health and efficiency. A strong EPS growth indicates a company's ability to increase its income over time, which is a green flag for investors seeking growth. Complementing EPS growth, sales per share growth is another cornerstone. This metric sheds light on the company's revenue growth relative to its share count, providing insights into its market expansion and operational success. It's not just about earning more, it's about efficiently scaling the business to benefit shareholders directly. SPGP doesn't stop at growth. It integrates a composite score that evaluates the quality and value of a company, ensuring that growth is both sustainable and reasonably priced. This holistic view includes assessing a company's financial health, operational efficiency, and market valuation, ensuring that investors are promising and grounded in solid financial principles. The financial leverage ratio is another critical measure of a company's debt relative to its equity. Lower leverage indicates a company is not overly dependent on debt, reducing risk and potentially increasing its resilience during economic downturns. Return on equity is another key performance indicator, revealing how effectively a company generates profits from its shareholders' investments. High ROE values are often a sign of competitive advantage and operational efficiency, qualities that SPGP value in its selection process. The price-earnings ratio, a staple in investment valuation, compares a company's share price to its earning per share. SPGP seeks companies with a reasonable P/E ratio, indicating that their stock prices are grounded in their actual earnings potential rather than speculative growth. Understanding these underlying principles offers a clear view of the strategic depth behind SPGP's success. It's not just about picking winners, it's about identifying companies poised for sustainable growth, grounded in solid financial health, and offered at a price that makes sense. This approach ensures that SPGP can navigate market fluctuations, leveraging growth while minimizing downside risk, making it a beacon for investors seeking stability and performance. Future prospects. Investing can be quite volatile, with the winds of market valuation shifting swiftly. With the market's evolving dynamics, particularly the tech-heavy learnings through giants like Nvidia, Meta, and Microsoft, concerns emerge about market gains being driven by a narrowing pool of stocks. This shift underscores the importance of SPGP's diversified approach, seeking out growth at sensible valuations, thus mitigating the risk of over-reliance on a few market drivers. The GARP strategy focuses on companies that balance robust earnings growth with reasonable valuations, offering a compelling counter to the potential volatility associated with such market concentration. As fewer stocks begin to drive market gains, the risk of pullbacks increase, spotlighting the wisdom in SPGP's methodical selection process. Several analysts have shared their perspectives on the Invesco S&P 500 GARP ETF, offering insights into its strategic positioning and future prospects in light of current market trends and valuation metrics. For instance, Zacks Equity Research points to SPGP as a beacon for investors navigating the shifting sands of the market landscape. The ETF's focus on the GARP strategy is praised for its potential to carve out a profitable path, blending the best of value and growth investing. Mark Rusin, CPA from the Motley Fool, included SPGP in his list of the 3 ETFs not named SCHD that I love for 2024. This recommendation reflects confidence in SPGP's strategy and its suitability for investors looking to diversify their portfolio with ETFs. Sangamitra Saha of Zacks also discussed SPGP in their piece, Why You Should Play Top-Ranked GARP ETF SPGP, advocating for the ETF as a top pick for investors drawn to the GARP strategy. The article suggests that SPGP is well positioned to deliver a profitable portfolio of stocks that balance value and growth. This analytical claim is echoed across the financial community, with insights suggesting that SPGP is well poised to thrive amidst market uncertainties. The ETF's disciplined approach to stock selection, emphasizing earnings and sales growth alongside key financial ratios, resonates with the forward-looking stance of investors seeking to balance growth with risk management. As we navigate 2024 with eyes on the uncertain future, the journey ahead, chartered with the insights of analysts and the steadfastness of GARP, promises to be a journey worth watching. In a market where a few technological titans increasingly dominate the narrative, SPGP's broad-based approach offers a diversification advantage. It's not just about riding the wave of current market favorites, but about identifying the next leaders before they command the market's premium price. So, what are your thoughts on this investment gem? Are you intrigued by the potential this ETF holds? Share your thoughts in the comments below. And don't forget to show support by giving this video a thumbs up and subscribe to our channel for more insightful content. Until next time, happy investing.